The retail motor industry is complex and multifaceted. The ability of dealers to make a decent return on their investment is highly dependent on their ability to manage all the moving parts. Over the years, it has become increasingly important to have a clearly articulated business model, one that can be used to inform management decision-making and engage management teams. While it is tempting to think that the business model would be the same across the industry, in reality, there are great variances in the way that dealers choose to run their business. Some dealers elect to have a high volume, low margin strategy, while others focus on fixed operations as a means of taking advantage of productivity and efficiency. Regardless of the fact or the decisions that dealers make, having a clearly articulated business model can be the difference between being a good dealer and a great dealer. Over the past 30 years, the Sewells Group has worked closely with dealers and OEMs across Asia Pacific, focusing expressly on the enhancement of retail performance. We do this across three primary business pillars, namely competency enhancement, process efficacy, and business management. Our business management solution in particular represents state-of-the-art thinking across the industry, focusing on network performance and shareholder returns. Combining education, analysis, and application, our approach focuses on capability building and the production of bottom-line business results. A key component of this is a tried and tested business management model, the MRA Performance Model. The Sewells MRA model is a high-level financial and performance analysis framework used to analyze automotive retail performance and to guide strategic decision-making. The model proposes that dealership financial health is measured by returns, or more specifically, return on operating assets. These returns are essentially the product of an organization's ability to produce gross, manage expenses, and turn its assets. The combination of these three key driving factors create what is known as a multiplier effect, allowing dealers to generate significant improvement in the end result by simply making incremental changes to each of the factors. The three key factors, mix, retained, and activity, are fueled by a number of enablers, including productivity, customer retention, processes, staff motivation, and culture. Let's take a closer look at the thinking behind each component. The Sewells MRA model has the ability to identify strengths and weaknesses across the dealership, revealing the impact of strategic decision-making. The first component of the model is mix. The mix in a dealership is represented by the relationship between gross profit and turnover. When we consider the makeup of a dealership, specifically the margins that are available to us from each department, we begin to realize the extent to which each department contributes determines the total gross profit that we are able to generate. To illustrate this point, consider that a well-run Australian dealership should produce around 15% gross profit as a percentage of sales. Taking into account the margins available in new and used sales departments will be far less than that available in parts and service, we can quickly determine how well balanced the dealership is. All things being equal, dealers with strong fixed operations will do better than those without and tend to have a richer mix and produce a great level of overall gross profit. The mix component is evident across all departments and also plays a significant role within each department. By way of example, the balance between retail, fleet and warranty in the service department has a significant bearing on their end result. The second component of our model is the retained factor. Essentially what we are looking at here is the relationship between gross profit and expenses, or more specifically the proportion of gross profit that the dealership manages to retain as profit before tax. Dealers who do this well have an ability to tightly manage their expense base through discipline, process management, and productivity. Each department has a responsibility to manage this component and to produce gross profit to cover their operating expenses. In terms of performance, if a dealer produces a gross profit mix of 15%, we would be looking for them to retain at least 20% of this, leaving them with a return on sales of 3%. The final component of the model examines the ability of dealers to generate throughput in relation to the assets they have employed. Asset management is a crucial consideration for all dealers. The investment required to simply operate the business on a daily basis is substantial, and the disciplines around stock management and control are critical for driving shareholder returns. The measurement of activity looks at a dealer's average operating assets in relation to their annual turnover. Well-run dealerships operate at 6 to 8 turns per annum. Once again, each department has a specific responsibility for driving their own activity, whether that be days stock on hand, receivables, or work in progress. Bear in mind, if a dealer manages to produce 3% return on sales and has an activity of 8 turns, that will result in a 24% return on operating assets. When considered together, the three components of the MRA model combine to form a multiplier effect, each one leveraging the performance of the next. When combined, the mixed retained and activity factors result in a return on operating assets figure. This is a crucial bottom line number for the dealer management team, one which provides tangible evidence of financial health. In our experience, having a business model is essential to long-term success in automotive retail. The MRA model provides a great framework for dealers looking to take their business to the next level. Its ability to inform the management team and guide strategic and tactical decision making is well proven and well worth considering.